It's 10 a.m. Good morning. This is Andy Cohen, president of Rock Properties. We're here for our fourth annual investment conference call. And we are live on Facebook, which is on a 20-second delay recently, but that will work fine. It'll take about a half hour. I will talk about some background and where we are and where we're going in the company. And then we'll take questions, which is always a fun part. Some housekeeping first. I just want to ask everybody to put their phones on mute if you're calling in until question time. And I've promised before, and this year Israel's going to throw a grapefruit at my head if I don't do it, but I'm going to repeat questions that people send in via via comments on Facebook or in the chat in Zoom. Facebook users will hear the questions from the phone calls this year. I think we have that worked out. And so everybody should hear the questions. And I think we're ready to go. So welcome everybody. We have about half a dozen people on the call, at least. I always start with an overview of the company. I'm going to back up for a minute. Peter Drucker, the management guru, said he's been attributed to saying, in business, culture eats strategy for lunch. So I'm going to talk about our culture for a minute because it means so much to us and I'm so proud of it. Most of you know our motto is inspiring our neighbors. Now, what exactly does that mean? And I'm going to take just a quick few minutes to talk about it, mostly because I heard a story yesterday that I want to share. Inspiring our neighbors. Most people in this world, there are people in this world who can barely take care of themselves. There are people who take care of themselves and their immediate family. Then there are people who take care of themselves, their immediate family, and their neighbors. And that's the kind of people that work for Rock Properties. Our staff are the kind of people who get satisfaction from doing good deeds and helping others. Every time they do something for somebody else, it fires a little bit of dopamine. They feel alive. They feel like they have a purpose. They feel like they're doing some good in this world. For people who aren't wired that way, they don't get it. It's almost incomprehensible. But there are people out there like that, and that's the kind of people we have on our staff. And I'm going to tell you a story I heard just yesterday afternoon. Nyendak, he manages, with his wife, Pema, they manage the Phil Oppenheimer building, the Howard Freeman building, the Dave Kirpin building, the Josh Landis building, the Nelson and Eve buildings in Newark, all known as Nyendak Apartments. And he got a call late last week at 12:30 in the morning. It rang 4 times and the person hung up. Now, I don't know about you, but if I get a call in the middle of the night and no one leaves a message and they hang up, I figure it's either a wrong number, a butt dial, or maybe an ex-girlfriend. That was a joke. But they just basically go back to sleep. He was sound asleep. He looked at the call and he said, that's from a tenant who never calls me. So and this is on his cell phone. He doesn't shunt tenant calls off to some office, voicemail system that he checks in the morning. He goes right to his cell phone by his bed. He calls the guy back. The guy says, I'm hurt. So this is a 24-degree night, and Nyendak gets on his clothes, walks 5 minutes down the block, a long block, to the building, uses his master key, and goes in and finds this elderly gentleman who lives alone, immobilized in his chair, can't move. And he claims he's been sitting there for 2 days. Nyendak got him some juice, not in his apartment. There was no food, nothing, no liquids in the apartment. He went across the hall, got him some juice, fed it to the guy. The guy chugged the bottle of juice, said he wanted to lie down. Nyendak said, I think you really need to go to the hospital. The guy said, okay. Nyendak called 911, and the gentleman is still in the hospital. I don't know his diagnosis, actually. Seems like he's doing better, but he's still in the hospital. It's not uncommon for our tenants to call their managers before they call 911. And we're going to honor Nyendak and his actions at our quarterly staff meeting, our all hands meeting in April. And we'll have other stories like that we celebrate among our staff. I don't know if God is in a mosque or if he's in a temple, a synagogue, a church, but I do know, and according to our philosophy, I do believe that when Nyendak does a good deed for this gentleman, that's like a spark passing from Nyendak's nose right to that gentleman's nose. He passes it on, and that spark doesn't die. That gentleman is now going to go somewhere and pass it on to somebody else. And that's what happens in our buildings. We do good deeds for the tenants every night. then they go out into the world and they pass on those good deeds to others. It ripples out from our buildings. And that belief is what motivates all of us here at the company and guides us and to do what we do. So very proud of that. I wanted to mention that and what Nendak did. Now, let me get into the next part of the call, the heart of the call. Usually, and we'll go for about 30 minutes or less, and I've been talking for 5, and I'll go for another 5 or 10 or so, maybe 10 minutes. The second part of the call where we talk, I'll start with this part. This is the part of the call where usually I have to apologize for not buying buildings. Now it's been 3+ years. We have not bought a new building. And believe me, if anybody wants us to go out and buy a building, we'll do it. They're out there. 150 units just came on the market on Nendak Street, right down the street, very similar to what we own. We could go buy them tomorrow. Call me afterwards and we'll invest. We'll do it. I also have some German bonds I want to sell you at the same time, which are, some of you know, getting negative returns right now. So some German government bonds. It's not fun to not be growing and buying buildings. On the other hand, we are keeping busy and growing and, you know, giving the staff raises and by taking on management from third parties. It keeps us busy in the meantime, and we learn from that, and we do enjoy running buildings. But we're not buying. And let me explain where we are right now. I got into housing to give people a place to live. I had moved to New York in the 80s. There were homeless people living on the streets, and I wanted to help them. I got into real estate ownership with our investors to make money while I sleep. I believed in the long-term residual cash flow that real estate generates, the steady returns. That to me is that's the definition of real estate, right? That when you think real estate, you think long-term steady cash flow. That was those books that came out in the 90s, No Money Down and Invest in Real Estate Now. That's what they do. That's what they were selling. A light bulb went off this fall in meetings with other real estate principals. I'm not talking about bankers or appraisers or sales agents or mortgage brokers. I'm talking about principals buying real estate. Suddenly a light bulb went off. The only people buying real estate for the last how many years, 3-4 years, are buying it because they have to. And they're not always happy about it. And why do they have to? Because their ability to maintain their overhead, their model, the way it's structured to maintain their overhead, to put food on the table, to cover their payroll every week, in order to do that, they have to buy and they have to sell. And I'm talking about the principals, the operators, the investors. Maybe they make some money on the purchase, and they definitely make fees while they own it, but the majority of their fees come at the back end, which is great. Everybody likes to see that. They make money along with the investors once, you know, everybody gets the return of capital. But the prices they're paying and the way the deals are structured, there is no cash flow to return capital and to make money for these operators unless they sell. So when they sell, they have to take the money and buy another one. And that works great when the market's appreciating. And there's been nothing but appreciation in multifamily for the last 8 to 10 years, 10 years. It's only going uphill. Now, what happens when interest rates go up 2% or when there's a capital crisis? Poof, that's where they all go. So we can't compete with that. We're long-term holders. That's what our model is. If we want to make a steady cash flow over the long term, we just can't compete. We're looking at other asset classes and trying to figure out if there's something else to do. Looking at houses in the suburbs, they're soft right now. And the suburbs actually last quarter started growing a little bit, but but multifamily right now, it's as good as investment as German bonds. So that's I wanted to talk about that. And one other thing, just about where we are at the properties, I'll talk about also there's usually a section on this call where we have to talk about some of the less advantageous news, maybe some bad news, something we're struggling with. This last 7 months, we didn't have that. It's been no speed bumps. I mean, 4 of the properties had their highest returns ever for the period. Everyone else is doing well. If they didn't hit huge returns, it's maybe because there was a huge tax increase at this quarter, and we're going to have to catch up a little bit. Property tax increase. Towns have been whacking us with their need to get revenue, but we catch up on that. Or we do major capital improvements. We have to do a roof for $100,000, parking lots for $100,000. That maybe we won't break any records with returns. We do exceed our expectations, but we're not breaking any records. But so we don't have to, there's that section of the call we don't have to talk about. So let's talk about the good news. In Pennsylvania, which has now been earning double-digit returns, and actually our average on returns, including mortgage amortization, the returns we got were into the 20% range average for all our properties, nothing below 11%. So Pennsylvania is one of them. It's recovered nicely, and we, as a lot of the investors there know, we wrapped there's one of the buildings, and there's 22 of them, 22 buildings on 13 acres, these 153 townhouses in Pennsylvania. We wrapped one in vinyl siding, 2-color vinyl siding, beautiful job. While we were doing it, the contractor was doing it. We met the manufacturer out there. They made sure we were doing it to their specifications. Everything was done right. Came out beautifully, totally transformative. It actually, doing one building lifted the whole community. And to do everything is going to cost about $800,000. These 153 units to wrap them in vinyl. Our bank, who has a first mortgage at 3.75% on the property, and we have that for 4 more years until we have to refinance it, has agreed to give us a second mortgage for up to $1 million at 6.75%. And we're going to take that. What are we going to do with it? We're going to wrap the buildings in vinyl. We also are going to take $200,000 and build a house on the property, a beautiful 2,000 square foot colonial house on the property, and we're going to move our managers into that house with their 2 children, and we're going to also move the leasing office into that house, into part of the garage, and we will then get $30,000 extra in rents for those 2 units that we're freeing up, that were non-rentable units. And also then we're going to wrap the properties in vinyl, and that means that the rents are only going to be going up. We've got an amazing reaction to the vinyl, and people are paying more for the property. Our rents could be considered under market even at this point, and we're just going to keep raising them steadily. So the first year, the mortgage is going to increase our debt service by about $63,000. 30 of that's going to be covered by the house. We're going to get another 45 just on steady rent increases for the existing tenants. Vacant apartments are going to go up even more than that. So within a year, we're going to be making more than that debt service. And for the next 4 years of mortgage, by the end, we'll be probably collecting at least $200,000 or $250,000 more a year on cash flow for this property, because we're wrapping in vinyl and making it a brand new community. It's approaching its 50th birthday, this property, and in time for its 50th birthday, 2023, it's going to look brand new. Very exciting. So that's my piece. I'd love to open it up to questions if anybody wants to join in on. Let's see, on Facebook, you can post comments. I'm looking, and also on Zoom, you can post comments or unmute your phones. And please, who do we have? Please, love to hear from you. If anybody has a question. I know we've had some good ones in the past, from Phil, from Nelson. Oh, okay. Wow, that's what happens when it's only good news.
Andy,
all right, everybody. Yeah, sure can.
Oh, okay. I was going to ask you to talk about the land that we have, because you and I talked about the land in Pennsylvania that we have when we're not sure what to do with, if we can do anything with it. So go ahead and talk about that. And don't forget about the time you wanted to sell it too, and we fought about it. We love our investors. We love our investors. We said, listen, after 5 or 6 years talking, we said, well, listen, we can get you back all your money and you can redeploy it. And at every single one, except one guy, but everybody else said, Andy, stick with it. Hang in there. We were getting about a 2% return. They said, it's going to go up. One guy wanted out, and another investor bought his shares and is doing better than ever with that. It was a good deal for both. He got his money and the investor got more shares. But
Yeah, so we love our investors. They have glue on their pants. They stick to the seats and wait for these things to turn around, and they do. So it's become incredible, and it's a appreciating asset for long term at this point. And we do have some extra land there. We're putting the house on one piece of it. We would like some storage for ourselves at the property. It's the townhouses. We had 3 small laundry room areas. We converted those to studios. So we don't really have much storage there. So we looked into building storage, and Howard and I talked about this last week. I actually mentioned on the conference call a year ago, and the rents are so low on storage that I just to have 20, 25 units there, we did not see it as a value. After we're done with the vinyl, we may look at it again and put some storage units there. I'd love to be in that business. The richest real estate guy on the Forbes 400 is the guy who founded Public Storage. It's a great business. You have like barely any heating, air conditioning, no tenants living there. Our buildings run 24 hours a day, 7 days a week, and storage is, I couldn't think of a better tenant. But we will look at that again over there. Yeah. I know people make money at it. Thank you, Howard.
You're welcome.
All right. Any other questions?
Andy, John Morris.
Buddy, John, how are you? Good. Love to hear from you.
How are you? Can you
Never better.
Give us a sense of the direction of the rental market where the properties are located. Do you expect in the near future to be able to increase rents? Are they stable? Any pressures?
Great question. Our buildings, we bought them and we didn't pay over $80,000 for any of our units. It costs 3 times that to build them. You cannot afford to build today for rents under $2,000 a unit. And the average working person can't afford that. There's no affordable housing program. I talked about this last time on the call. There's no affordable housing program in the federal government. They're out of that business, sadly. I think Microsoft announced in Seattle they're going to be putting, I don't remember the number. Was it, who cares, 50 million, 500 million, I don't remember what it was, into affordable housing in Seattle. Big news, right? That's sad when corporations are stepping in to build affordable housing for the people of this country. And it's not good for anybody if people don't have a good place to live. I mean, it's just not, it's not healthy for anybody. And New York has committed to affordable housing since the 80s. And that's why the city hasn't rioted at times where other cities have. People in the neighborhoods know they have their most basic need met, and housing is people's most basic need. I'll prove that to you at another time. But you cannot, our housing can't be replaced. So what does that mean for there's no competition. Nobody's putting in apartments that we're renting between $900 to under $2,000 a month, most of them, and now we're cracking 2,000 in some of our markets. But so there's no competition. So rents are just going to slowly and steadily go up. And that's why people are putting so much money into these buildings, because they are, in fact, irreplaceable. But when you start getting up to 150, 200,000 a unit, then you can build for that. The only affordable housing program we have right now is all these rentals you see going up in urban centers, near train stations, in New Rochelle, where John is, pick a city, basically, all over the South. All these rental apartments, Newark, Hoboken, all over the whole country, you see them. These rental apartments go, Atlanta covering the city with these rentals, and they all rent out. That's the affordable housing for 2070. Those apartments are going to be, people are going to be moving in there when they wear out. Unfortunately, they're only built for a 30-year mortgage. I mean, they're not built very well like our buildings were. But so we have no competition on our rents. They're just going to slowly, steadily go up. Some of our buildings are rent control, but even there, there's built-in increases, some better than others, but it does go up. Most towns let us improve the apartments and capture the capital costs in rent increases, even in rent control. But Newark's been a little oppressive on that, but our rents do go up. So yeah, long term, here's the trajectory. I don't know if you can see my hand. That's the trajectory long term if you're on Zoom. Slow and steady uphill. Yeah, it's a great asset to own.
Cool. Thanks.
But you have to continually invest in it. It's like a taxi cab, or an Uber car. It runs 24 hours a day, 7 days a week, but it wears out. The brakes wear out, the tires wear out. You have to replace them. You constantly have to invest. But it'll go for the long term. And you know what? I give credit to the rest of the people out there. It used to be in the old days, people bought buildings, milked them, ran them into the ground and then gave them back to the bank, gave them back to the government. Most guys now are fixing up their buildings. We're not the only ones. I mean, you can't afford to do that anymore. But there are plenty of guys who buy buildings and sell it 2-3 years later and did very little. Just ran it poorly and barely hang on, and they sell it for more 2 or 3 years later. Eventually, you know, that ends. But good question. Anything
Andy?
else? Yeah.
Howard again, Andy.
Hey, Howard, good.
Yeah, I have a small investment. It's the Elizabeth property. 2020, we have a big change coming there because we made a deal years ago for 75% or something of the apartments held in
Right.
certain. And do you have a plan when that happens to, we're refinancing, I think, in 2020, those apartments come up. We're not going to throw people out. I mean, we're going to take care of them. But do you have a program set for that?
Well, yeah, that's good. Howard's quoting, you know, debt service rates. He knows our buildings. He and I bounce ideas off each other, you know, once a month or so. So yeah, we do have a mortgage coming due then, but doesn't scare us. There's a second mortgage on that building for $500,000. It's at 1%. It was given to us by the city. Because of it, we have to cap 40 of the apartments for affordable tenants who make certain incomes only. And Israel's here. He knows. He works hard on making sure we qualify with the paperwork and certifications on those tenants. And that will end in, I guess, 3.5 years. And we'll pay back that mortgage. And by refinancing the first mortgage, which is about $1.5 million, and the second mortgage, which is $500,000, a $2 million mortgage on the building. $2 million mortgage on the building is still very low leverage on that building. And the rents are only going up. We're reinvesting continually. And so we will refinance where rates will be. If they are up 2%, it won't really affect us. If they're up more, it won't affect us. So, and even 4 years from now, those will be different buildings with all the work we're doing, you know. So, yeah, so we'll refinance that out, and we will no longer have to certify the income levels, which is quite a process, pretty arduous. The city makes it much more difficult than it needs to be. You know, as I say, there's no such thing as red tape. There's just people who require red tape and insist on red tape, and we have some of those in Elizabeth, but you know, we comply with it. And in 4 years, we'll refinance, put a new mortgage on it, and keep running it straight market rate, and we'll have more freedom to raise the rents even at that point too. Won't be affordable anymore.
What about Millburn?
Good question.
Millburn. We refinanced Millburn. We paid down a lot of the principal with the money that we got for half of the antenna fees. And yet Millburn doesn't seem to pick up much. Is there some problem with...
No, I wouldn't say, that's a good question. Millburn's our smallest building. That's the only one we paid over $50,000 for a unit at the time, and that was 2010. And so we paid a lot for it. It's in one of the nicest towns in New Jersey. I actually pay rent in that building along with everybody else. I live there. And we did pay down, so it had a higher, more debt and more leverage than any other buildings. We did pay that down, and it maybe makes around 8-10% returns every year. That's really, I think, a function mostly of being such a small building. There's only 17 apartments in it. You know, you need a super, you need a boiler, you need a roof, you have all the operations of a building. There's just not that much total income. But we've tried a lot of different things. Right now we have somebody paying, I don't know, what is it, 10% over market for a furnished apartment that we furnished. So we're getting another, you know, $300 or $400 a month there. And we're trying different finishes in the apartments. We gutted a bathroom, brought it really up to like designer quality. And I don't think people really responded to the bathroom so much. I mean, it's clean, and so we wouldn't spend that kind of money again. But yeah, it's going to always make money. It'll be steady. If we, you know, shouldn't be any major capital hits there. If we have to do a boiler one year, we actually feel it in the returns. But yeah, I think it's just a function of the size. It's just the economies of scale there. We don't have them.
What about the unit that's attached to it, the other apartment building next to it? The people that run that must be suffering to some extent. Maybe they someday want to get rid of it at a low price. Is it possible?
The sister building next door?
Yes.
That's a good question. Howard knows our buildings. That's a second generation family who've owned it forever. They certainly felt entitled to buying our building, and we kind of snuck it out from under their noses when we bought it.
But they'll sit and hold that forever. They have
Okay.
a whole generation living off the cash flow of that, and they're one of the largest owners in New Jersey.
Okay.
Yeah.
That answers that question.
Good question. Well, this is the time we usually wrap up in a minute or two. One last question, anybody? That's some good ones. It's always a fun part of the call.
Thank you very much.
Thanks, everybody. All right. Well, I'll stay in touch. Thanks for joining.
Bye-bye now.
Take care. Bye-bye.